All right, guys, it's 9 o'clock. Let's get started. Good morning. Thank you for joining us for this is our webinar on employee stock ownership plans. With me this morning is David Cheney, CEO and founder of the firm Legacy and Succession. In addition, we have Dan Zugell, Director and Senior Vice President of Business Transition Advisors in Pittsburgh, Pennsylvania. Dan has a wealth of hands-on and management experience spanning many financial service disciplines. Dan's experience includes the formation of MetLife's ESOP program and as a director of MetLife's Institutional Specialized Benefit Resource Division. Since 1998, Dan has emerged as a national presence on ESOP matters as a frequently published author and featured speaker. Guys, thank you both for being with us this morning. And Dan, I will hand it off to you and get started.
Wonderful. Thank you. It's a pleasure to be with you again. I look forward to presenting this today. And afterwards, you are more than welcome to have a copy of this presentation should you want it, and happy to answer any questions you may have after the presentation. You can reach me through my contact or through my good friends at Legacy and Succession. So let's get rolling here. Employee stock ownership plans, an introduction. So ESOPs can be somewhat technical when you get really in the weeds. I thought today we'd kind of talk higher level. What are they? How do they work? What happens to what happens with the taxes? What happens to my family? Who's in control? What value do we get for this? And just, kind of general overall, how's it function? And so I thought we'd stick there today. Be happy to go deeper at a later time if you'd like to do that. So we started with this, I think Vince Lombardi said, gentlemen, this is a football. Well, this is an ESOP, and you hear that term and we refer to it as ESOP, but it stands for Employee Stock Ownership Plan. Ownership plan. It's not stock options. Some people confuse the two sometimes. It's an ESOP, is Employee Stock Ownership Plan. It's a real deal qualified retirement plan set forth by the Department of Labor, the IRS, overseen by those two departments. It's a retirement plan and a cousin to 401ks, pension plans, that things that you've heard of, profit sharing plans, things you've heard of your whole life. ESOPs literally in the same category as those under these watchful eye of these government agencies. Now, the purpose of ESOPs way back in the day, in 1974, when it kind of got in their current form, it was designed as a vehicle to benefit employees, but also to help America's workforce by providing an exit strategy for American business owners. They saw the devastating effects of jobs moving overseas, owners just shutting down their facilities and people losing their jobs. They said, what can we do to help facilitate American jobs sustainability and growth, and help our workforce have a comfortable retirement? So they developed ESOPs for a way of doing that, because they saw what happened when, unfortunately, a lot of other bad things happen when businesses get sold to foreign companies, relocation, pay cuts, efficiencies, which means layoffs. They take a patent and shut down the plant. And they also wanted to ease the burden on the government safety nets. And so what we do is we have both parties that really like ESOPs. In fact, it was very positive provisions in the Secure Act that was just passed that are pro-ESOP, developing state centers for employee ownership in every state and funding them. So both parties really like it. And the reason I start there is because when I talk about the tax advantages, many times I get, sounds too good to be true. They're never going to put up with this very long. They're going to close these loopholes. And the reason I stress this is that they don't look at these tax benefits as loopholes at all. They look at it as a way of solving a problem of employees being laid off, employees not having enough money to live on, and employers not having an exit strategy that works. So they kind of combine those, give some tax benefits. And just to kind of prove my point, and I'm not going to read these, but I often get some chuckles when I have a Bernie Sanders and a Ronald Reagan quote supporting the exact same topic. I beg you, what other topic ever in the history of politics would Ronald Reagan and Bernie Sanders agree on something? But they do, and they do. And a lot of modern politicians do as well. Trump did a pro-ESOP speech. You have the Bernie Sanders of the world, the AOCs of the world, you got the Chuck Grassley's of the world, you got, so you have them just all across the board, broad bipartisan support, and that's no signs of going away. In fact, I bet it's like half the state legislatures, including my state of Pennsylvania here, there's pro ESOP legislation to actually encourage more ESOPs, to actually increase the tax benefits that we're going to talk about in a second. And the power of employee ownership, which is why I guess politicians, and they're looking at their district like ESOPs, is during the 2008 recession. And it's showing to hold true during COVID that employee owners and employees of ESOP companies were 4 times less likely to be laid off than their counterparts at a similar company without an ESOP. So job stability really got us through some of those tough times. And there's a lot of reasons for that. Companies have some tax advantages, they're a little stronger. Employees have an ownership stake in the company, they think differently. I love this second bullet point here. And this is really hits home to me. All things being equal, an employee at an ESOP company averages a retirement plan balance 2.5 times greater than the equivalent employee at an equivalent company that only has a 401k. Employees at ESOP companies average 2.5 times greater retirement plan balance when they retire than a same employee at a non-ESOP company. Pretty dramatic. That's a lot more people with independent wealth, a lot less people on government safety nets, a lot more people spending money in their retirement and generating taxes and sales tax and other things to the economy, buying cars, doing the things that raise revenue and increase to the coffers of the federal, state, and local governments. Employees average higher wages, higher job growth rate for ESOP companies, sales increase, just all around the board, ESOP companies outperform their peers. Now in Oklahoma, I did some homework here. There are about 69 ESOPs in Oklahoma, and we need to change that. You're well behind the national average. And so I'm so looking forward to working with Legacy and Succession. And we've been doing some good things, talking about ESOP just as an exit strategy and an option on the list until it's crossed out, unless you have a better option. ESOP's often the best option. The problem is people don't know about it. Their attorneys didn't say anything about it. Their CPA didn't say anything, and other business succession folks kind of were afraid to talk about it. But we're changing that. And with the federal momentum, many state momentum, ESOPs are coming around. They're going to have another surge. They're in the midst of a surge, especially with the silver tsunami of baby boomer business owners that have businesses with fewer buyers out there. ESOPs are really coming to the forefront. So you have about 40,000 participants under ESOP plans in Oklahoma, which is far behind national average. We're going to jump on our horse and do that. But hey, even with that little number, the ESOPs in Oklahoma with 70 companies hold $3.5 billion that are being split by those 40,000 employees. I mean, that's the magnitude of ESOPs. That's a lot of money per employee. And most ESOP companies have under 100 employees, and that's a national average there. So that they don't have to be gigantic companies. ESOPs start working at 20, 25, 30 employees. And we'll talk a little bit more about the profile of ESOP candidates. And in the last year that was recorded, I believe it was 2021, these numbers might be 20. Oklahoma's ESOPs paid over $2.12 million in benefits to some of those 40,000 ESOP participants that are in plans in Oklahoma. So the numbers are there. When you get an ESOP in place, the numbers are high compared to the low number of ESOPs, but we're working on this. Now, as far as who does ESOPs in Oklahoma, this is Oklahoma specifically, finance and insurance. You had a couple big financial type firms that have done ESOPs, but then you have some retail, manufacturing. No, just FYI for national averages, ESOPs tend to be the bluer collars. The transportation, manufacturing is generally the national top category of ESOP companies. And then there's construction, you have the finance, wholesale, construction. I think I said that already, distribution, warehouse management, things of that sort. But you have kind of skewed numbers because of the relatively low number you have in your state. Okay. get into those tax benefits that sometimes people think are too hard to believe. I'm going to highlight a few of them. There are tax laws that were developed for ESOPs back in 1974 that were made in a time where generally every company was a C Corp. That was before S Corps, before LLCs, before a lot of these different structures. So some of the tax laws around ESOPs are for C Corp companies. Now, but S Corps can do ESOPs, and other pass-throughs that convert to an S can do ESOPs as well. So unfortunately, they haven't reconciled this. This is what we're trying to do nationally, is to kind of reconcile the ESOP tax benefits, but right now they are separate. So for a company that is currently a C Corp or a company that wants to convert to a C Corp, this is the tax advantage that's available to the C Corp. If you this special law, it's like a 1031 real estate exchange. If you've ever had some land and sold it and bought a new piece of land, you didn't have to recognize a gain on that. You didn't have to pay tax. Life insurance, it's called 1035, IRC 1035. Well, a little further down the code, 1031 real estate, 1035 life insurance, 1042 ESOPs says if you sell your stock of an American company to your ESOP of your C Corp, you can defer and then eliminate the capital gains taxes that are normally due if you sold your business. You can eliminate the capital gains tax that you'd normally have to pay when you sell your business. That's anything above your total investment and the sales price. That difference is a capital gain, just like me buying a share of IBM stock. I buy it for $1, I sell it for 10. I pay tax on $9 because that's the gain. Same thing here. Normally you sell your business, anything between what you sold it for and your total investment is normally taxed as capital gains, both federal and state, if you have state income tax or capital gains tax. And in ESOPs, the only way I know of that you don't have to pay capital gains tax on the sale proceeds. And that alone was like an incentive to do an ESOP. And that was the old school, the way ESOPs all got done. But there's an additional tax advantage. Let's skip to number 3. This is kind of one of the drivers of modern ESOPs, where you want to ultimately be is a 100% ESOP owned S corporation. So that means taking the S election. So if you're C now, you can do the ESOP there, defer and eliminate the capital gains, then take an S election. Or if you're currently already an S corporation, you already get this benefit. If you're 100% ESOP owned S corporation, your profits cease to be taxable. Nobody pays tax anymore on the profits. You don't pay taxes because you sold your business. You don't own it. You don't get the K-1. You don't get the tax form anymore. You don't claim the business income as your taxable income. The ESOP gets the tax bill. The ESOP's a retirement plan, just like a 401k, and neither pay taxes. They don't owe taxes. It's not deferred. It's not pushed down the road. It just literally the tax goes away on the profits. And so the company keeps all that money that used to go out the door so the owners can pay their tax because they still had to pay tax. That money that went out the door as distributions no longer leaves the company so the owners can pay tax. It's redirected to pay off the debt we incurred to buy 100% of the stock. So we're literally just using money that used to go to federal and state governments and redirecting it to pay off the debt we incurred to buy the stock from the selling shareholder. And that continues long after the selling shareholder was paid off. It just goes right to the bottom line to grow and prosper and buy companies, buy competitors, underbid jobs for those high profile ones. It's wonderful. It's wonderful to see. So you can see there's 2 very dramatic, incredible tax advantages of an ESOP. And about 20-25% of the time we can get both. And for sake of time, we don't have time to cover that, but we can often get both of these benefits about 20-25% of the time. You don't have to choose, especially if you're already a C Corp. If you're not already a C Corp, there's other ways we can potentially do it. And then we'll touch on some significant family estate and charitable planning ideas, opportunities when we get a little further down the line. Now, as far as, hey, what's an ESOP candidate look like? What kind of size companies? Well, I mentioned more than half of all ESOPs have under 100 employees, but that means, little under half have more. But where an ESOP starts working, we're looking for a firm, and these are just guidelines, but this is where the numbers start crunching and working properly properly, and the benefits outweigh the fees of putting in ESOPs and maintaining them. About 25 or more employees, payroll of $1 million or 2 million or more. I generally say $1 million. We would like a business value of about $10 million. So if you think you're kind of in that range, perhaps an ESOP might fit. And believe it or not, it's sometimes it's not as hard to get to that number as many people think. We start adding back owner's excess salary, adding back some things. Maybe people are running through the business that shouldn't be running through the business, which we all do. But we start adding things back, add back one-time expenses and things of that sort. We can get to about a $2 million of EBITDA, net earnings plus depreciation, amortization, add back some excess salaries, things of that sort. We can get to that number. With that being said, we've done ESOPs down to maybe $1 million of EBITDA, or $5, $6, $7 million of value. So don't rule yourself out or your clients out. Just these are just guidelines, but when you get to the $10 million mark, everything really makes sense. All right, I'm gonna take a deep breath, take a sip of water here. Hope everything's okay with everybody. Now, the ESOP structure, okay, how does it work? Well, there's a lot of diagrams. You go out online and you Google ESOP diagram or how does an ESOP work, you're gonna get a zillion, including my corporate website. And I even have one in a couple of slides here that we're not going to dwell on it, but I think sometimes the diagrams go into the weeds too much. This is really what's happening. It's not, I used to say it's not rocket surgery, kidding, but people thought I was serious. But here's how it works. The ESOP borrows money. So let's just say you have a favorite bank, and let's just assume the bank's going to lend all of the money, which they won't, but we'll talk about that in a little bit. But for our purposes of understanding how an ESOP works, the bank's going to lend us the money. So this ESOP, this new qualified retirement plan you have at the company, it borrows money from a bank. It uses that money to buy the selling shareholders' shares. The company uses the tax savings we just discovered, contributes it to the ESOP every year. The ESOP uses that cash to pay off the debt. So summary again, ESOP borrows money, uses that money to buy the stock of the selling shareholders. The company contributes to its ESOP every year, the tax savings, and the ESOP uses that tax savings to pay off the debt. And it's just done that way until the debt's repaid. Now, as far as the employees go, now, even though the ESOP purchases often, doesn't have to, but often purchases 100% of the stock of the company day one, that doesn't mean that the stock is all handed out day one. Because this is the purpose of an ESOP is a long-term retirement plan to benefit employees. And it's also a recruiting and retention tool for the company. So we put on our employee benefits hat and we recruit to, hey, come work for us or stay working for us. We're handing out stock that our ESOP purchased. We're handing it out over the next 40 years or 30 years or 20 years, whatever the case may be. We'll be back into that with you. But hey, come work for us. Every year you work here, you're getting more shares. And every year you work hard and you help grow revenue and you decrease expenses and you have a dog in this fight now and you improve the well-being of the company, the stock value goes up. So you get more shares and you're helping build value. And then when you retire or die or becomes disabled, the company has a legal obligation and desire and they want to, but buy your shares back from you. And then you take that money, roll it into an IRA, and you have a wonderful, happy retirement, hopefully much more than you would have had with the 401k alone. Pretty exciting. There's the diagram I said I have for you, but you're welcome to have this presentation. You can look at it as your leisure. This is just some more detail that we're not going to get too super into. It's the IRC section 1042, the code section that says, if you have an American company that happens to be a C Corp and you sell your stock to the ESOP of that C Corp, and if you do some of the caveats the government wants you to do, you reinvest into other US stocks and bonds, you can defer and then eventually eliminate the capital gains tax that's normally due. I'm not going to dig too much deeper into that. We could do another whole webinar if you want to do that. Now, a little more detail on the S Corp, which is kind of the driver of modern ESOPs, the fact that we found the cash flow to finance 100% sale. Back in the day when only C Corps were doing ESOPs, we couldn't cash flow 100% sale. We could only cash through maybe a 30, 35% sale at a time. and you had to manage your company, make payroll, pay taxes, and then pay off debt to the ESOP, which is why ESOPs in the old days took forever to buy the selling shareholder out. Well, now that S corps can do ESOPs and taxes aren't paid and the taxes aren't leaving the company, or money isn't leaving the company for tax purposes, it can all be redirected to pay off the debt, and the company has its normal operating cash flow to run the business. And so this is kind of the modern ESOPs here. So they're not subject to federal state income tax. In fact, let's go to the next page because this illustrates a little bit here. This is a company before an ESOP. The company earns profits, you deduct things, everything you possibly can, you buy equipment maybe you don't necessarily want, but you're doing everything you can to lower your taxable income. Then your CPA prepares the K1, which is the tax form that says how much income you're responsible for. It goes to the owners, proportionate to their ownership. The owners then file, you have their CPA, or they do it themselves, they file their 1040, and the company, the board of the company declares distributions, which is usually the owners, right? But you declare distributions, maybe 40% of the profits. So for every million you earn, maybe 400,000 is declared in distribution, goes to the owners in proportion to their ownership, and they use that money to pay their tax. That's pretty much every flow through organization. Now, after an ESOP, if an ESOP's 100%, this kind of the same thing happens, except the company's not worried about deducting everything anymore because the profits aren't taxed. You don't worry about depreciation, don't worry about buying equipment for the write-offs and all that kind of thing. It's a mindset change. But either way, there's still a K1 that's prepared. The K1 still goes to the owner. However, in our scenario today, in this example, the ESOP's the shareholder. It's a qualified trust for the benefit of the employees. It's an employee benefit plan. It, like a 401k, files a 5500, not a 1040 or not a corporate income tax return. It files an informational report to the Department of Labor just to tell them how many employees are in the plan and what the assets of the plan are. No taxes are due. So therefore, the company and the board, which is a little cat out of the bag for a later slide, the sellers can remain in the board, president, CEO, and chair of the board, and control the board indefinitely, even when you sell over 51%. So the board says, we vote to not declare distributions this year and next year or the year after. You no longer declare distributions because the profits aren't taxed. And so that money stays in the company. And that money that stays in the company is what's used to contribute to the ESOP so the ESOP can pay off its debt. And the company still has the normal operating cash flow to run the business. Maybe some extra. Here's just an example of a company not paying tax. It's a simple example, really, really simple. So those sophisticated folks out there, I know there's some nuances you can, but I'm just saying taxable income of $4 million over 15 years, that's 60 million of taxable income at an average federal and state rate of 42%. It's about 25 million in taxes, leaves you with just under $35 million. In the ESOP side on the right here, no taxes are paid to federal or state governments. You're left with all 60, but that difference of 25.2 is more than the sale price. So the tax savings, almost every scenario, is greater than the sales price of the company. All right, kind of switch gears a tad here. Often the questions I get is, well, okay, fine. Who's in control? If I sell more than 51% of my stock to my employees, the ESOP, can they vote me out of a job? Or they run in the company? Do they have access to confidential information? And the answer to all of that is no. In fact, the employees never technically own stock. Even though it's called an employee stock ownership plan, the employees actually have a beneficial interest in the ESOP trust that owns stock on their behalf. So they don't technically own it, which means they do not have statutory minority shareholder rights. They don't have the legal rights that I would have if I bought 1% of your company. If I had one share of stock with certain information you'd have to share with me, the employees don't technically have any right to that information. So they do not have, they can't call shareholder meetings. They do not see payroll. They do not see list of biggest customers. They don't see strategic plans. But what they do see is a statement every year that says, here's how many shares I have, here's how many more shares I have, here's how vested I am, and here's my total balance right now. There is now, with that being said, even though the employees aren't voting the shares, there is an owner, which is the ESOP, and that's represented by a trustee. There are special ESOP trustees out there. That's all they do. It's a handful. It's a small universe. We know them all. They actually vote the shares on behalf of the employees, but are not allowed to share the confidential information of the company. So the trustee, now you might say, well, then the trustee can fire me and my family. And the answer is, in the strictest sense, yes. However, on the practical sense, and I've been doing it 24 years, and I've had one scenario in 24 years where the trustee actually had to get rid of a board member, which was the selling shareholder, and that's because they were violating the law. The trustee, and they were putting everybody in jeopardy. And so the owner had to step in, the owner being the trustee, had to step in and do something to save the company because the owner was doing something illegal. And so the trustee has zero desire to run Joe's Cement Company. Zero. They don't know how to run Joe's Cement Company. They don't want the liability. They would rather take all advice and all direction from the board of the company, which is, like I said before, seller, seller's family, seller's spouse, friend, key manager, son-in-law, daughter-in-law, whatever. If that is perpetuated by the family or the seller and their designees all through the foreseeable future. And so the trustee will say, what's going on? Let me see the financials. Let's look at the valuation this year. What's your strategic vision? What have you done? What's last year look like? Fantastic. I bless that. I vote that way you're asking me to more often than not, almost every time. And I'll see you next year. That's kind of how that works. And, it might sound, I don't know, if you need proof of that, there's plenty of ESOP former owners that are now chair of the board that can attest to that. And I could line up a bunch of trustees to tell you this, that will tell you the same thing. Now, as far as what value do you get? And this is another kind of, it's actually a misnomer. It's a myth, I should say. People often say to me, I like the concept of an ESOP. I like the fact that my employees might get to keep their jobs versus another method, they might get laid off. I like my employees are going to, grandpa's picture still in the foyer because, often that gets taken down. I'm glad my patent's going to stay here in my town. I'm not going to shut down my business, take my patent and build this stuff in China. That's all great. I love that stuff, but I hear I'm not getting as much money for my business, which isn't true. ESOP is a financial buyer, just like me or David or Colby. Financial buyers were coming in to say, look, we'll give you fair market value, revenue rolling 5960 standards. Just technical mumbo jumbo, I guess. That just means willing seller, willing buyer, all relevant facts on the table, and just kind of come to a fair price for both of us. That's how that works. Now, where an ESOP cannot compete is against some crazy money. For a while, there's some crazy strategic money and some private equity money that just had burning a hole in pockets. They were going well above market value, well above financial buyer value, which is the predominant way businesses are sold, by the way. It's the financial buyer. Every now and then, you got some crazy money. You're always going to have, some business or some buyer is going to come in and offer something silly. Hey, you might want to consider taking it. If it's not going to, crush your employee base, not going to crush your town from losing you as a manufacturer or whatever you do, you have to weigh all that, and that's on your conscience. But that, however that works for you, if you're reassured everything's going to be great and people are going to keep their jobs and your family's still employed, you might want to take that big offer. That's obviously up to you. Okay. I remember I said there was kind of two main drivers of modern ESOPs. One is the fact that when you're not paying income tax on profits, we have the cash flow to finance even 100% sale. Well, the flip side of that is the second driver of modern ESOPs is, okay, well, how do we finance this ESOP? We have the cash flow to do it, but do we have institutions that are going to fund 100% sale, even though I can cash flow it? And the answer is yes and no. And I'm not even an attorney, but I say yes and no, or it depends. However, more often than not, this is how it works. We have bank financing to the extent the bank will lend money. Now, banks will lend typically 1.5 to 2 times your adjusted net income or EBITDA. And then the balance We could either find an outside, what we call a mezzanine lender, somebody that's willing to sit subordinate to a bank, or more often than not, we like to advise our clients, the sellers, to say, look, take what the bank gives you, and then you can receive installment payments over a period of years based on what cash flow allows until you're paid off. And we're going to reward you substantially for agreeing to that. That's what we normally do. Now, let me explain how this works. Now, I'm not saying to do this. This is the first option I said you potentially could do, but we're not crazy about this option. But if the seller needed and wanted 100% of this cash upfront for the sale, we can maybe do that. You know, the bank will lend, and I have down there 2 to 3 times EBITDA. That's not modern. I'd say 1.5 to 2.5 EBITDA today. The bank will lend that. Then we could potentially find somebody like maybe our, I don't know, some guy down the road says, I'm looking for an alternative investment. I'm willing to lend the company, lend the company money. I'll sit behind the bank and I'll be interest only and only get my interest when the bank gets paid. I'm willing to do that. But they're not taking what the bank's taking right now at 6% or so, right? Who would do that? That's crazy. Saying if I'm taking that extra risk, I'm subordinate and I'm interest only, I need 10 to 12 or 13% to make that worth my while. So with that being said, I'm saying don't do that. It's really expensive. So what we recommend is that our sellers, our clients, take, and like I mentioned, an installment note or a seller note, a subordinate seller note for anything above what the bank will lend. Now, you as seller are entitled to a market rate of interest. So the question is, well, what is market rate of interest? Is it what the bank's charging at 6% today? Or is the market rate of interest what anybody else would be charging to sit in that subordinate interest only position? And of course, it's the latter. So the sellers deserve a total return of that 10, 11, 12, 13%, because technically you're sitting behind the bank and subordinate and interest only and only get paid if the bank gets paid. Now, and so you deserve that because technically you're taking that risk. Now, take a little parentheses here. But I would argue, really, what's the big difference between you holding your equity today and doing nothing, or you're still president, CEO, chair of the board, and you owe yourself money, and you're managing your company to pay you back, to pay you money for the sale? I would argue that in reality, the risk isn't a ton different, but from a lending standpoint, it is significantly different. So you deserve that total rate of return, that 10, 11, 12, 13%. Now, nothing's that simple, of course, right? There's some problems with that. And one of the 3 problems are, A, many banks, most banks will say, look, you're paying somebody else 12% out the door, we're out. We're not lending and having you pay 12% interest out the door. It's gonna be harder to pay back our bank loan. We're out, we're not participating in that. The second thing is the trustee of the ESOP, the one overseeing the ESOP for the benefit of the employees, says, man, that's really hurting the stock value growth. I'm trying to grow. I want value to grow for my employees so they have a nice benefit when they retire. You're paying somebody 10, 12, 13% out the door. That's hurting the stock value growth. And from you, we're all on the same side of the table here. From our side of the table, your standpoint, when you get seller notes and you're getting interest payments on those seller notes at 10, 11, 12%, that interest is taxable as ordinary income. So you're losing a big chunk of that. So we say, okay, hold on. Nobody really likes it. So what else could we do instead of just getting that high rate of interest, but still achieve that total return or greater? What can we do? Well, here's what we do. We say to the seller, look, let's make everybody happy, including lowering your tax burden. Match the bank. Take the 6% the bank's taking. So you got whatever the bank gave you on the first time, 1.5, 2 times your EBITDA, or 30% of the company, wherever the case may be. Then you get your payments yearly or quarterly at 6% interest until you're paid out. We understand you're leaving something on the table. So what we're going to do to make up that difference, or a lot more, is when all of that debt's paid off, when you're paid off 100% of the value of the company, you had what the bank gave you up front, You had your seller note payments over a period of years based on what cash flow allows at 6%. When you have 100% of the sale price in your pocket, you say, remember when I gave up some interest? We said, yes, we do. So at that moment, you get another check of about 20% of whatever the value of this tax-free company is on that day. So that might be 6, 8 years from now. Whatever the value is, you get another check of about 20% of the, or 20 or 25%, 15 to 25%, somewhere in there, of whatever the then value of that tax-free company is. That's amazing. So if you're a $20 million company today, most likely in almost every scenario, so you're probably worth 32 million by the time the debt's repaid. And you get 15 to 25% of that number as the reward for bearing that subordinate seller debt. You made the bank happy by reducing your interest rate. You made the trustee happy by helping the stock value growth, which helps you now, right? And it lowered your tax burden because you're going to lose half your interest payments to taxes. And you trade that for 20% of a accelerated growth company because it's tax-free, 20 to 25% of whatever that value is at that time. And that is taxed as capital gains, not as ordinary income as that interest would have been. So it's often in absolute dollars, considerably more money in the seller's pocket. Just have to wait a little bit for it over time that you're still president, CEO, and chair of the board for as long as you want. You're overseeing this. And then you get, when you get it, a higher number, it's taxed at half the rate because now it's taxed as capital gains, not ordinary income as the interest payments would have been. Here's when we summarize it all down here. This is a client of mine. They were worth about $40 million. We got this a little high right now, but they got 16 million from the bank. And in their scenario, they were able to elect IRC section 1042 and not pay capital gains tax on the $16 million. That's the bank down payment. They also had seller notes or installment payments over a period of years of about $24 million. And that was also for them tax-free. But if you don't qualify or don't want 1042, and there's some reasons not to, you would have to pay capital gains tax on $24 million, the same as the 16. So that entire 40 million, the principal portion of the sale, is either taxable as capital gains or not taxed at all. Seller notes had installment payments over a period of time. They got about $9 million in, this was a lower rate back then, but $9 million in interest on the seller notes, and that was taxable as ordinary income. But they did get warrants, 20% of the value of the company, of the value of the company, and then on the day that all the debt was repaid, got another $12 million taxed as capital gains. So about over $61 million, on a company that was originally worth 40, on a very, very tax advantaged way. It's a nice number. So when people say, I don't get as much when I sell to an ESOP, I beg to differ. I beg to differ. You can often get much more absolute dollars and taxed much more favorably because it's about what you keep, right? It's not what you can brag about your multiples at the club. It's about what did you get to keep in your pocket. And I would argue you keep more in your pocket with an ESOP than you do most other methods. And you're doing a wonderful, wonderful thing for your personal and family legacy, your community, and in the economic benefit of the state and your community. So, in preserving the legacy of grandma and grandpa's picture in the foyer of the founder of the company, and preserving all those jobs. You feel good about yourself. You're a hero. And like I said, you're still involved as long as you want. You can walk away when you want, but you can still be all the main positions of the company or name your designees, your top managers, your kids, your family, whatever the case may be. You can still be in an ESOP more often than not. You still get salary, healthcare, phone, clubs, car, perks, those kind of things. And then profits remain tax-free into the indefinite future. Now, just to touch really briefly on, this is a major life event for many business owners, right? You sell your business. It's really the time to get with legacy and succession folks to talk about your personal and charitable planning personal estate and personal charitable desires and goals, because we're doing something major here. We're selling a business, which is often the largest asset many people have. And just some of the ideas here, you can gift the financing vehicles. That's really kind of one of the biggest thing here. You gift your the warrants, that future equity stake. The day you get those, the day you get that future equity stake of 20 to 25% of the future value of the company, it's a payment that's not expected to be paid for 6, 8, 10 years. And it's on a company that is literally 100% leveraged against the value. It's like I have 100% mortgage against my house. So the equity value of that future equity stake is extremely low. Pennies, literally pennies on a dollar, 3 or 5 pennies on a dollar, the value the day you get those, knowing darn well, just by paying off the debt, when all the other debt's paid off, you're getting 20% of the then value of the company. It's a tremendous arbitrage there. So you can gift away those future equity stake the day you get it, because it's hardly worth anything at all. Get that out of your estate. Get that into kids and grandkids' estates for pennies towards your lifetime gift and estate tax limits. It's a great way to do that. And the seller notes too. The seller notes are interest only and subordinate to a bank. They can be discounted from what I hear 40 to 60%. So there's some wonderful opportunities to transfer out of your generation to future generations, and also some tremendous times to do your charitable planning. Because with that 1042, which is the ability to not pay capital gains tax, you can sell to the ESOP, not pay capital gains tax, and then donate the untaxed money to the charities of your choice, your college, your church, your synagogue, whatever is important to you. It's a great way of getting more money, taking what would have gone as tax dollars and adding that onto your tax benefit. Plus, you get another deduction for it. So there's some really tremendous gift, estate, and charitable planning ideas. That's just the tip of the iceberg. The objections I get with ESOPs, oh man, they're complicated. I guess they are, but I also know some of the best wealth and gift, estate, and tax planning ideas can be complicated. And I know, we bring in the folks, legacy and succession, and my firm, we bring in the folks to do these different things. Our friends at Legacy and Succession are incredible at these technical techniques, but know how to explain them and bring in the right individuals. And when you can suffer through some of the details, it's really worth it. And by potentially not paying tax on profits ever again, potentially not paying capital gains tax on the sale proceeds, saving on my employees' jobs, maybe it's not a bad idea to maybe sit through and maybe listen to some of these details. And believe me, we make it as painless as possible. I also hear ESOPs are expensive. Well, that's completely relative. I know from business brokers, ESOPs are often half the percentage that it costs you to sell a business with a business broker. It's relative. Is the cost of putting in an ESOP, is it expensive compared to not paying capital gains tax on your proceeds? Is it expensive compared to not paying tax on profits ever again? I would argue that's relatively very cost-effective method of doing an ESOP. The other myth is that employees are going to run the company. We talked about that. That's not true. I hear ESOPs are difficult to finance. That's absolutely not true. Banks, all things being equal, love lending to a company that's not paying income tax on the profits, that have 40% more cash flow. And what they really like is, and my banker friends are on the horn here watching us, that it's actually 3 loans for the banker. We didn't get into this, but there's 3 loans. They had an initial loan, then that's usually a 5-year loan. That the average payoff of that 5-year loan, because the company has so much cash because they're tax-free, the average payoff's 3.5 years. The banker comes in and says, hey, thanks for paying that 5-year loan off in 3.5 years. Can I finance the balance? Can I refinance your seller notes for you and give you all cash today instead of you waiting another 7 years? How about I refinance your seller notes and give you that cash in your pocket today? And then when that happens, you pay that off. And then when that's paid off in maybe another 3.5 years, then the banker can finance that future equity stake. In my example, another $12 million. So the banker can get 3 consecutive loans. That helps you get cash in your pocket a lot quicker too. So banks generally do not object to ESOPs. They really like them when they understand them. Now, I don't have this slide here, but I often get the question, okay, what are the pitfalls? This is all, sunshine and rainbows and unicorns. What's the downsides? Well, the downsides are we have to make sure we have very, very steady cash flow. Not steady. We have ample cash flow. Now, we've increased cash flow from not paying tax on profits, and many businesses, especially like construction, things like that, have up and down. So what we do is we adjust how long are the seller notes. We can maybe sell less to the ESOP and maybe adjust the seller notes, make them longer, maybe ask the bank for a 7-year amortization and just prepay them. There's never a prepayment penalty when we have good years, but we could bring down our required payment substantially if we have up and down cash flows, and we're concerned about that. I get that question a lot. I literally have some people saying, I do not like my employees. And I've had this, and I'm not judging, but I'm just saying, they've said, these employees have been trying to unionize over the last 30 years. I do not want them to have shares of stock in my company. I just don't. That's not what I'm going to do. Fine, I understand that. Another thing is another thing to watch out for, and we plan for it. In fact, this is where, man, I just love the way Colby and David and the rest of the team handle this. But there's something called repurchase liability. This is remember I kind of mentioned it in passing early on, that when the employee leaves, they die, become disabled, they retire, and even if they quit or get fired, they get their vested balance. The company must make a market for that stock. So you have to be, and it benefits the company. You don't want them walking away with the stock either, right? You don't want your company's stock running around Oklahoma. And then in 40 years, they come to you and say, hey, I have a share of your stock. I contributed nothing towards because I'm not there anymore, but I want to cash it in. You don't want that to happen. So it actually works out better that they're required to sell their stock back to you and you're required to buy it back. And so we had to prepare for that. And that's something we want to make sure we take care of. And when we do this ESOP, part of what my firm does is we'll provide you a 20-year liability stream. What's that going to cost you? What's that look like? The buyback of this stock, what does that look like? And then my friends at Legacy and Succession, they're experts in what's the best method of preparing for that. Should we use a bucket of bonds? Should we use a balanced mutual fund? Should we do stocks and bonds? Should we do, believe it or not, there's like life insurance is extremely effective in this scenario. Life insurance has been used, it is still used very, very widely by big banks, and the Fortune 1000 companies use it to finance their long-term liabilities because it's actually very efficient. When I'm talking about like the institutional type products, not the mom and pop products that I buy so my kid can go to college if I get hit by a bus. These are kind of corporate institutional type policies that are used, can be very, very effective. And most people haven't heard of these, and I have no dog in that fight because I don't sell insurance or investments or anything like that. I'm just going on my 24 years of experience that you need to do something. You need to do something. And you bury some money in a tin can in the backyard is better than nothing. But I suggest talking to our friends here at Legacy and working out, what do you think the best way of preparing for that liability is? What financial methods the best way of doing it? Building a war chest on your corporate balance sheet for that eventual purpose of buying back stock. So just want to touch that on some of the kind of what are the downsides? What are we going to be concerned about? Well, those are what we got to be concerned about. We also got to be concerned about not discriminating because it's a qualified retirement plan. You discriminate, which none of you will do, I'm sure, but the Department of Labor will come in and say, why'd you give Susie her money in a lump sum and you gave Joey over here's money over 5 years and they left for the same reason? You got to be consistent, and we dig into all that later. So as far as, okay, how does it work? How do I get started? This sounds fantastic, or I'm skeptical, but I'd like to learn more. Well, this was a complimentary client ESOP 101. We didn't get personal. I'm happy to do, we are all happy at Legacy and Succession and me, based on your relationship with my relationship with them and their relationship with you. We offer several complimentary things. One, be happy to do several, as many as you want, complimentary ESOP 101s or introduction to ESOPs. We can factor in your corporate situation, your corporate entity type. I'm an LLC, I'm an S Corp, I'm a C Corp, or my kid's going to take over. How does that work? We can incorporate that stuff into that and get a little more flavor of how it would work in your scenario. Or we're happy to do a complimentary, even written ESOP financial review. We'll ask for a set of information. It's actually, we ask for 5 years of financials, a forecast if you have it, trailing 12-month report, and maybe a fact finder, stuff like that. And our professional team, we're a national firm, one of the premier ESOP firms in the country that hooked up with Legacy and Succession. We're happy to get our crack team to provide a multi-point review, financial review, to see if an ESOP makes sense to even pursue it all. And we can put that in writing. We can have a discussion about it and say, look, let's talk in 3 years. Let's clear up this debt. Let's steady out this cash flow. Let's clean up the personal stuff that's being run through. We'll have some frank conversations like that just between us. And then we can reconvene later, or maybe it sounds great. You say, what's next? It works. Well, then we have what we call a preliminary evaluation, preliminary analysis. And by the way, other than the complimentary stuff, most people that do ESOPs, I don't want this to be commercial about us. I want it to be commercial about ESOPs. I think most of my competitors would do almost all the same stuff, but I don't know if they do complimentary stuff. But other than that, I think we all do kind of the same stuff. Not as many do this one step here called preliminary evaluation, preliminary analysis, where for a very nominal amount, give you a value you can hang your hat on, and then model a couple scenarios that you think might be most interesting to you. Just kind of way of getting your feet wet. And then every provider will want to do, before implementation, a feasibility study. It's the blueprint for implementation. So whether you do any of the other stuff, you're thinking about an ESOP, you eventually have to get to a feasibility study, regardless of what you did prior. That's the blueprint for implementation. Personal cash flow statements. We're talking to your bank and maybe some other ones to keep them honest. Drawing out exactly what that future equity stakes will look like, exactly what your seller notes look like, your exact payments. We tax affect that. We recommend stock split changes if they need be, and all that kind of stuff. It's all laid out in the feasibility study. And then implementation is that after that feasibility study phase, yes, I see what it would look like. It's the best option for us. So for me, my family, my company, let's do it. But then we pull the trigger. We go hire all the folks that are needed. We need a trustee. We bring them all to the table, by the way. You're not on your own to try to find them. You need a trustee's valuation firm, trustee's lawyer. We need an ERISA lawyer. We get back involved. We need a third-party administrator. So there's a lot of steps. That's where the heavy lifting really comes into play. That's where a lot of the expense comes into play. But you can see there's a lot of steps to get there. It's not like you've heard this presentation and then David and Colby are going to call, or Madison is going to call you and say, do you want to do an ESOP? A lot of steps, a lot of checkpoints, a lot of time to say yay or nay. And then if you go through the steps or most of the steps, you want to pull the trigger, darn well, and you feel really, really, really good about it by that point. Then we pull the trigger and we put the ESOP in place. Now, I have an example here that I'm going to leave for you. If you want the presentation, you can have this actual case study of a live client of ours. And just the bottom line is the original value that, whoops, where'd it go? Sorry, I'm giving away everything here. The original value of the company, I should know this. I do this all the time. I just want to make sure I get it right. Company's worth about $56 million. Oh, didn't have the total. I must have cut that slide out, but well, anyway, the warrants, in addition to that $56 million, this company got about $40 million in warrants on top of the 60. And the corporate tax savings over the 15 years it took to complete this was $67 million. Pretty dramatic. There's our handsome pictures there. I got that little haze going, that little Doris Day action there. Little chubby cheeks, but another two good-looking guys there, Colby and David. So that's my story. I'm sticking to it. Thank you for having me. I loved coming to visit. Had a great time. Look forward to coming back out. And let's get those number of ESOPs up in Oklahoma, way behind the country there. We need to share this benefit because it's pretty dramatic, as you can see. And I look forward to meeting you.
Hey, Dan, thank you so much for your time and all this valuable information. At this time, I kind of wanted to bring David in and have him maybe chime in for just a second and just give some thoughts and opinions, perspectives on some of the things that he has seen in his time with ESOPs.
Thanks, Colby. I want to thank everybody for joining us today, and we have recorded this presentation if anybody would like to look at it again at a future date. Again, this is all part of our series that we're putting on business owner exit strategies and business succession planning. Again, it's our belief that most people should start many years ahead of time developing their exit strategy and their succession plan. One thing I like best about the ESOP plans is you might be planning as an owner. I'm 60 years old myself, and let's say at 70, I do want to exit. An ESOP provides multiple paydays that we could start maybe this year, next year, and begin my exit and begin my succession plan, and also begin my paydays. So if I could set up an ESOP plan, in the next year or two, even though I'm not going to exit for 7 or 8 years, that's really ideal, because then I get a chunk of money up front. I also get another chunk of money later. And as Dan said, if I'm willing to carry some of the note, I could also do some exchanging or enlighten self-interest for myself, as well as benefit my company by creating multiple paydays in the future, where maybe I sell my company not once but twice and maybe 3 times, as far as when I get paid, to complete my financial independence plan. So it's a really great tool. It's also a great tool to integrate with charitable planning, as Dan mentioned. And next month, we're going to be bringing in a speaker from the Oklahoma City Community Foundation, and we'll be putting on a presentation of how do you involve a charity in your exit strategy of your company and the succession of your company. So Joe Carter will be joining us from the Oklahoma City Community Foundation. We'll also have a couple of special guest speakers, Donnie Beller and Ronnie Beller of B&H Construction, kind of talk about some of the things they do in their company. We'll try to do this on each one of our meetings going forward, where we maybe spotlight one of our clients and some of the unique value that they provide to their companies and to their employees and to the communities that they live in. Again, we're a firm that strives to focus not only on the success of the businesses and our owners, but also what we can give back to our communities that help us grow and provide us the great people that work for our companies and help us achieve the success that we achieve across the state of Oklahoma. So again, I want to thank Dan and BTA and Colby for helping put this on today. And hopefully you all found this valuable. And we look forward to seeing you in July at our next meeting. Have a great 4th of July holiday.
Thank you, guys. Thanks for everyone for being here. Thanks, Dan and David and everyone in attendance. And we look forward to working with you guys and answering any questions that you may have regarding ESOPs or anything else that pertains to succession planning or legacy planning for your family. So thank you for joining us today.
Thanks. Bye.
Thank you.